Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the 10th of the podcast focusing exclusively on the markets, and this series is coming to you regularly every month. Bringing insights from market experts is your host, Parvatha Vardhini. I am the editor of bl.portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Aashish Somaiyaa, CEO of WhiteOak Capital AMC. Aashish has over 20 years of experience in business strategy and management, sales and distribution, as well as product development and marketing of investment offerings. Prior to WhiteOak Capital, Aashish served for nearly 8 years as MD and CEO of Motilal Oswal AMC. Aashish was also the head of sales and distribution at ICICI Prudential AMC for their MF, PMS, and real estate offerings. Hi, Aashish. Welcome to the podcast.
Hi, thank you for having me. It's a pleasure to be here.
Very interesting time for the markets. Every time I do a podcast, I tend to tell this, but actually it's been quite interesting, isn't it, with election and volatility and, markets touching all-time highs and all that.
It's always interesting or exciting when there is something to look forward to.
Yeah.
So, that keeps the market engaged and keeps the market going.
Right.
Otherwise you hear about VIX, people complaining about VIX being very low. That's not exciting enough for people, I think.
Nobody's bothered about volatility. Otherwise, yeah.
Yes.
Yeah, sir. So actually, this Sunday, we did a story. We looked at BSE All Cap. And then, we kind of figured that while the market may, the bellwethers may be touching all-time highs, if you see the BSE All Cap Index, whether large cap as a segment or mid cap or small caps, there has been very limited participation. Not all stocks, very less participation in terms of stocks, individual stocks touching all-time highs. So, do you also see this rally as not so broad-based, and do you think that stock selection would have mattered actually?
In fact, what I've realized is that in the last 2 to 3 months, when February, March, when the talk started coming that, small caps have gone up a lot, mid caps have gone up a lot. I distinctly remember that in the month of March, BSE 500 was flat, but small cap index was about 4 to 5% down, right? I think from there on, the market has become a little bit more discerning. But if you were to say, for example, look at March 2023, right up to March 2024, barring a blip here or two, the movement in small cap, and small cap is generalized. Within small cap, if it is PSU, it was just one-way kind of movement. So my sense is, on your question that did stock picking matter, I think from March 2024 onwards, February, March 24 onwards, I think it has been a little bit more choosy, picky, and discerning. Also a bit of tilt towards good governance, good quality kind of movement, minor change in the last 2 to 3 months. But before that, if you really ask me, everything which is cyclical, commodity, energy, power, railway, defense, PSU, and, generally the small cap space, the financial year 2024, more or less, I think everything was just going up unilaterally.
Okay. So that way, sir, you feel there is no bubble in small and mid caps? Has the earnings growth been faster here than large caps, and our valuations still looking, not in bubble zone?
See, there will be, sorry, and I don't mean to give philosophical answer, but to be honest, at any point in time in the market, if you look closely enough, there will be a bubble in some part of the market and there'll be massive undervaluation in some part of the market. But leaving those generalizations and philosophies aside, if you really ask me, the difference is basically the broad-based, you're after a long point in time, you're seeing double-digit nominal GDP growth. See, look at it this way. The last time we had a sustained phase of double-digit nominal GDP growth was, say, 2003 to 2008. After that, at the worst point in 2019, I think our nominal GDP growth itself was some 6%. So, when the nominal GDP growth itself is 6%, you can imagine why earnings growth would be 5, 6, 7, 8% or, mid single digit or high single digit earning growth. And you can imagine that for such a vast corporate universe, if you get 6-7% earning growth, it means that few companies are doing well, but a broad range of companies is doing badly. That's how those numbers would pan out. But after 2021, after FY21, now if you see, you're finding, high double-digit earnings growth, and you're finding nominal GDP growth after after a very long gap. Nominal GDP growth, is coming to say 13% and 12% and 14% and those kind of ballpark. So no wonder that you are seeing some amount of broad-based excitement. But for a bubble to be there, markets have to go way beyond earnings. On the other hand, if you take 5-year data of at least Nifty, I remember, verbally, 5-year data, if you see, Nifty is in line with the EPS growth of Nifty. And I suspect that if you take Nifty 500, it will not be like way off the ballpark. I mean, it will not be completely wrong. So I would say that there will always be some parts which are in bubble and some parts which are cheap. Stock markets are always mean reverting, cyclical. They always work on relative valuations. All that is fine. But I don't think that there is a bubble. For a bubble to be feared, market has to go way ahead of earnings.
Okay, sir. You did mention certain sectors which have done well. I had this question. Do you think the rally in, say, your defense or PSUs or real estate or autos, that way has more legs? So do you see a sector rotation happening anytime soon?
Like I'm alluded to, relative valuation. So then what happens? You take an example. Okay, now this is not a recommendation, but just take an example. On a 5-year basis, this is, now we are in May end, the data is not updated with me, but as of 30th April, 5-year CAGR of private sector bank index was about 8% compounded. But 5-year CAGR of PSU bank index was 21% compounded. As against this, you take the long period average, like 15-year average. 15-year average, you will find exactly the reverse, meaning that private sector bank index, which on a 5-year basis is 8% CAGR, on 15-year basis, that too after having 5 bad years, on a 15-year basis, it is 19% compound. And PSU index, after having 5-year CAGR 21%, on a 15-year basis is still about 11%. So that tells you that, what is long-range sustenance where people expect or where people have witnessed versus what is currently happening. So that's why I said, market is like a pendulum, right? I mean, it will always tend to swing to extremes. There were points in time people used to think that, we will never be able to buy HDFC Bank kind of stock because it's perpetually expensive.
Yeah.
Now people are saying it is trading well below its long period averages, but people don't want to, touch it.
Yeah, so you're saying that there is opportunity right now in the private banking space vis-a-vis the sectors that have already rallied?
Yeah, but the people want to look at what is hot, right? I mean, that's how the market plays tricks, right? Or for example, if you went to Bombay Central Station to catch a Vande Bharat train, you basically, if the train is standing on the station and doing nothing, you will look around and kill time. But if the train starts moving, you will just run and try to jump in. Nobody wants to get into a train which is stationary on the station. Everybody wants to get into a running train, right?
Understood, sir. Sir, the result season is still on. So what is your reading of the Q4 results? So do you see any surprises or any disappointments?
No, I think the traction has been good. I mean, while one would be worried about, numbers coming lower or slowing down, etc., as was widely feared. But I think there is not much of a slowdown really. It's not like okay, it's coming off a high base and then you expect things to slow down, etc. Not really. In fact, earnings has been, I wouldn't say big surprise, but the surprise is that it has sustained and there is positive trajectory.
Okay. So going into FY25, so even as we have seen, it's like first 2 quarters of FY24 was probably a lot of tailwinds from lower raw material costs and all that. And, you saw very high bottom line growth and very less top line growth. Slightly towards the end of FY24, the picture is slightly changing. So what is your outlook for FY25 on 2 things? Number one, in terms of top line and, demand making a comeback. And number 2, in terms of, your earnings estimates or what do you expect? What kind of a growth do you expect?
See, I think financials, like, previous quarters, I mean, say if you go 9 to 12 months back, it was all about commodities and cyclicals. In recent quarters, financials. So, some or the other big part of the market seems to be supporting. So I think financials, there is traction. I think that would sustain. like you rightly said, of course, the pressure from raw materials, pressure from commodities, and oil has also not kind of, I mean, it's not very cheap, but definitely it has not shown a big spike. So net, my sense is that, if we are showing, say, about 15 to 18% kind of growth, I mean, generally what people are anticipating is about 15 to 18% kind of growth. I think that looks to be a achievable number. Plus, whatever noises are being made about, rain forecasts and those kinds of things. Plus, I think, generally it is expected that when there is an election which has played out for the last 45 days, with some lag effect, that also results in significant amount of spending and consumption, or at least flow of money in the system, right? So net, my sense is that, we would sustain. And at some point in time, I think, right now the headwinds are obviously from the external environment. That doesn't seem to be changing anytime soon. But at least to the extent that we are getting some traction and domestically centered sectors, I think that would sustain. So a high teens kind of growth is what one would, play for.
Okay. So, consumption in particular, you did say that there is a spending catch-up which could happen post-elections and all that. But if we see post-COVID, consumption in particular, all of us would agree there has been a K-shaped recovery. And is it getting more broad-based as you see, for example, in Q4? And do you expect it to get more broad-based next year? Or is it going to be kind of lopsided and concentrated in certain sectors?
No, see, it looks like anything to do with discretionary or anything to do with urban or anything to do with not exactly luxury, but at least the high end. That is what seems to be drawing maximum traction, even if you see travel and leisure and hotels. And so the discretionary part is what, autos also, if you see real estate, if you see. So anything which is related to discretionary spends, related to slightly affluent, it still shows signs of that K-shaped behavior only. I don't think, if you see, even when we were into this election season, whenever anybody wanted to make a point against or, point to the contra, and the rural, numbers of consumer companies like FMCG companies, the rural, situation, I think that is what was being quoted. And there doesn't seem to be like a turnaround really as of yet. So as of now, unfortunately, it still looks like K-shape. One has to watch for the spread to come through. And I think that, I distinctly remember after 1st February when the budget came, one of our friends in the media specifically asked the finance secretary that, rural demand and consumption seems to be very, very weak. And he said that it's not the job of the government. Every time FMCG companies have a slowdown, it's not the job of the government to provide any impetus or stimulus. So I think those kind of symptoms have been discussed now for quite a few months, right? I think eventually you expect that the government will do something to broad base or, create stimulus for the wider economy. And not just let it remain with, the upper end or the affluent or the discretionary side of things. So yes, there seems to be that stress. And one would hope for it to change, but not sure. Unless I'm missing something, I don't think we have seen any green shoots as yet.
Okay. So you expect then top line to be driven by manufacturing and banking and
financials,
services.
manufacturing, industrials, those kind of parts currently seem to be showing more traction.
Okay, sir. And gold usually is said to have a very low correlation with equities, but we are at a time when both equity and gold is all touching all-time highs. And then there is the other factor on debt, which is coming in saying it's going to be higher for longer and all. Now, do you subscribe to the view that, a lot of fund houses now are promoting their, multi-asset allocation funds because of the situation that we are in? So what is your view?
So in all humility, I really think that you made a very important point, which is that equity has low correlation with gold, which is true. But the funny thing is, all those statements made by you and me, about equity with low correlation with gold, all those statements hold true as long as you are 1 rupee of equity versus 1 rupee of gold. Unfortunately, in our industry, multi-asset funds are quite misunderstood because while we talk of low correlation and tabulate the correlation data, and then when we are constructing the product, we find that it is 6 to 7 rupees equity and 1 rupee of gold. Right? Most multi-asset funds in our industry are so prefixated that they have to qualify for equity-oriented taxation that ultimately they forget the role of correlation and asset allocation. They start chasing equity taxation. Now, the moment you chase equity taxation, you are putting 65, 70 rupees into equity. After that, you can do arbitrage and calibrate and all. But in terms of 100 rupees given by the investor, 65 to 70 has gone into equity. Then for arbitrage and for debt, you will have 20%. So you'll be left with only 10% in gold. So while people are offering multi-asset allocation funds, idea is right that when you expect, you don't know what is going to happen in US policy. What if their economy tanks? What if the dollar depreciates? What if gold prices go up? What if there is a geopolitical event? So there is enough amount of uncertainty or event risk to go about whereby you think that your equity should be hedged with gold. All those ideas are right. But if you are ultimately, when you execute the asset allocation or you construct the product, if you put 7 rupees of equity and 1 rupee of gold, that 1 rupee of gold is not going to do too much. Just like it is ornamental in many other places, here also it will only end up being ornamental if the ratio is 1:7. So in fact, it would be called a product plug, but we have deliberately created a multi-asset allocation fund where we have very equitable allocation. Like we are generally 25 to 30% equity, 25 to 30% gold, and another 40% in short-term debt. So I think multi-asset funds have to be constructed scientifically. That's my limited point. If they are done scientifically, they have a lot of scope. But currently, what vast majority of the industry is doing is not truly a multi-asset. That's what I would submit.
Okay, sir. Okay. And, since you did mention elections at the beginning of the conversation, I did have this question. We are doing it so close to the election, so we can't miss it. Has been some noises on capital gains, F&O, this, that. So I'm not getting into that. But basically, based on your broad reading of the manifesto, so whatever the current government has done, so, you can consider both scenarios, either the incumbent government continues or a new government comes in. So how do you foresee markets, say, in the medium term or over the next 3 or 5 years? I'm not talking of the near immediate term changes. But do you see the themes that have driven markets so far continuing?
I'll tell you. So, look, if there is a change of dispensation, so what is the long-term reading of the market? The market has done equally well or not so well or, equally badly or whichever way you look at it. Market has had its ups and downs irrespective of the dispensation, right? In 2004, the market was down circuit because unfortunately NDA lost. But in 2009, the market was up circuit because UPA had a second term. In 2014, the market was up because unfortunately UPA lost and NDA came back to power. So market has, behaved both ways for the same set of results. Market has behaved in stark contrast. So my learning is that ultimately in the market, if the economic traction is good, market wants continuity. If the economy is sputtering and stuttering, the market wants change. Right now, perceivedly we are in an upswing, so market might be hoping for continuity. So if you get continuity, you will find that not only there is my sense is there will be upside in the market if you get continuity. If there is a discontinuity, there would be a correction, and then market would reassess its situation. Correct. And once you have a correction, then what would get impacted is all this, the investment-led sectors of the market. And you would roll back into the defensives and the so-called quality and those kinds of things. And then after a particular period of consolidation, then the market would reassess that is their policy continuity, what is changing, what is not changing. But definitely if there's change of dispensation, first the market would have some knee-jerk reaction and reassess. Go back to the defensives and then reassess and then kind of come back. But ultimately, like I already clarified, in the long trajectory, one has seen the correlation is only with economic performance and not necessarily with any one dispensation.
Okay, sir. Most of the newer fund houses have been really actively launching passive funds. So if we look at WhiteOak's product suite, as of now, you have not been active on the passive side. So is there a particular strategy that you're following?
So, look, I think I am a believer that there is a scope for coexistence. In a previous avatar, I have done a lot of hard work to introduce a lot of passives to the market. Like when I used to work with Motilal Oswal, for instance, we had this Nasdaq and S&P 500 and Nifty 500. And in fact, I launched along with the help of my colleagues, I launched a whole basket. Small cap, mid cap, next 50, and the works. And one of my long-term beliefs has been that if you're a new entrant in the market, you don't know where to start. You start by buying the market itself. Buy the whole basket. So, I think that for certain segment of people at certain points in time, passives have a role to play. I have no doubt. And a lot of times the arguments are as if it's a matter of dharma or religion. That active versus passive. For me, it's not a matter of religion or dharma. I think it's just about what works for which client, what works for what type of portfolio, what are the expectations of the client or the intermediary, and accordingly they will choose the product. Now coming to WhiteOak, if you really ask me, our entire ethos or capability or competency is geared towards researching a very wide array of, we have 32 analysts covering 700 plus companies, right? Second is that it's a well-known fact that the inefficiencies and potential for outperformance is more in the micro cap, small cap, and the mid cap kind of segments. And we kind of, claim to be pretty good at identifying, and that is the long trajectory of, Prashant, who's our founder. Before founding WhiteOak, he was, CIO for Goldman Sachs Asset Management, long track record of managing money in India. And we have a total very large fund management team of about 46 people at WhiteOak. Out of this, that's why I said 32 people are covering just Indian equities. So our prime focus here is to beat the benchmark. And, that's why we are, offering active products. Second thing I want to tell you is that a lot of, while I feel that, as an asset management company, different players, they are right in fulfilling client requirements. But if you ask me, my belief, really, if you ask me, to the extent that a lot of discourse in India about active and passive is informed by what happened in US, I think there we need to step back and take some reality checks. I'll just tell you one thing which you'll be surprised with. Do you know that in the last 25 years in the US, the market cap has gone up more than 3 times, almost 4 times. But number of listed companies has halved, right? So now just think that, while people say efficiency, institutionalization, that is all true. There is institutionalization, but in the US, there is institutionalization, but institutions put 60% of their money in private markets.
Okay.
So in the US, over a long period of 25, 30 years, what has happened is that the alpha has moved from the public market to the private market.
Okay.
That is, how else do you explain 50% reduction in number of listed companies? How else do you explain this whole cult of pre-IPO crossover, VC, PE? And I'll tell you, you'll be surprised to know in the last 25 to 30 years in US, the corpus of buyout funds has gone from practically 500 million to nearly 2 trillion plus. Correct. So in India, people who make save, bhujia and potato wafer, they are still getting listed. So I think that there is still scope in India for people like us to do a lot of work on smaller companies and make the effort to outperform, right? But as far as clients and intermediaries are concerned, I think they should be driven by their risk return preferences and what works for them. We are on our path in the quest for what we think we can achieve. If we outperform, people will back us. And if we don't, then obviously we'll not find enough backers. That is how markets work.
Yeah, got it, sir. Great, sir. Thank you. Thanks a lot for your time. It was very interesting. I'm sure the listeners will also like it a lot. Thank you so much.
Thank you for having me. Nice talking to you.
Nice speaking to you, sir. Thanks. Bye.